Last week, I gave some key themes to be looking out for in 2024, but today I want to focus on some key charts in the FX and gold space. I think it's really, really important to focus on these products right now. And then for the trading takeout, I'm going to be talking about sentiment again. I really, really think that sentiment is something that we all have to focus on to develop a better edge in the markets through 2024. And if it's the first time that you are watching these videos, please hit subscribe so that I can pop up in your feeds with the best market news, tips, and analysis out there. So first up, we've got the euro. I'm going to keep chucking this chart at you because it dominates the FX space. It's the most important one to focus on. And, you know, I just want to keep reiterating how technically sound it appears to be. The euro, as we know, has various different geopolitical issues going on right now. You know, German trade has been decimated completely, probably requires a lower euro as well to be able to function on the global stage, to make European goods and services become more attractive to foreign buyers. But regardless of all of those issues that, you know, really should determine that the euro heads lower throughout the year, we should all have this this chart imprinted into our brains now. You know, this is the 200 weekly moving average. And this is the 15-year trend line. I mean, it's pretty self-explanatory. This is basic stuff. As I've said previously, the market has never beaten its previous high whenever we started a new cycle. You can see that here. It's pretty astounding. Let me just absolutely highlight that for you so it's very, very evident. And, you know, we're entering a new thematic cycle where we've had the rate hikes. Now we're having rate cuts, and they're starting to get priced into the ECB's projections in the short-term interest rate futures quite quickly. I think March actually is when it was set to be a rate cut, but I think that was pushed back after the German CPI. It was found that the German CPI was quite a lot stronger than what was first expected. It was, however, a bit of a mixed bag, could have influence because of Christmas and more goods being purchased, but we'll see how that develops. But the key thing here for me technically is that this market has very little capability to get back above its previous key high, which is one spot, let's say call it 1.13. If it does get there, then I'd suggest that something has changed, because we'd be both above the 200 weekly moving average and above that prior key high, of which there's never been a break of it. Even you can see here, it looks very similar to here back in, excuse me, 2021, where we saw, you know, this level create the high, it trade back up here, but fail. Yeah, you can see here, this level here created the high, traded back up, failed right at the 200 weekly moving average. This is bread and butter stuff here on the euro. I think it may take some sort of real risk-off behavior to really accelerate it, because we've seen this kind of chop through 2023, haven't we? But we're forming now the right conditions, I think, for a broader head lower. I think as well, if we move over to CHF JPY. Now, this is obviously something that is quite it's an abstract pair. But the reason why I want to focus on this is because you may expect a big reversion in yen sentiment. Okay, you might expect a massive, massive reversion in the yen. We're not getting it yet, but I think this would be the pair to look at if this were to start occurring, if there were to be more moderation in monetary policy from the Swiss National Bank, and if the Bank of Japan were to also start to increase interest rates. I think that would be very, very vital, because what we're seeing there is two economies, two central banks, which have very, very similar monetary policies, now reverting back. They're doing something that was disrupted over the pandemic in terms of their loose interest rate policy that made it tighter. And then now they are having to revert back now. Okay, so these are the things that we need to be focusing on. And you can see, markets tend to be mean reverting most of the time. You can see generally here, for about 20 odd years, it was relatively mean reverting. It's only just in the last, say, 8 years that it's decided to just start trending. Well, the last 3 or 4 where it's really started to trend hard. Okay, so you could expect the status of the market to change in terms of, it's gone from a mean reverting market generally to very much a trending market over the last 4 years. This is all due to the changes in monetary policy. The Swiss National Bank diverting from their unconventional monetary policy, going to more conventional monetary policy to combat inflation post-pandemic. So definitely another one to keep an eye on. And third and finally, very, very important, cable. Okay, cable is in the very similar situation as the euro. Okay, I think this is something key to bear in mind here. So we're at the 200 daily moving average. Sorry, I keep saying daily. 200 weekly moving average. Sorry, just like the euro is. And personally, I think that this will have to revert lower. And the key reason why I think this will revert lower is not to do with. It's more to do with something a bit more abstract, and it's the connection between housing in the UK and GDP. I think housing in the UK makes up something like 20% of the GDP quota, and it's one of the easiest ways to manipulate things because people in the UK are so brainwashed into thinking property is everything, that if they're able to lower interest rates, that will induce buying and that would gradually shift up GDP. It's ridiculous, though, because it's totally unproductive, right? It's unproductive to invest in that. But in terms of that, this would probably decide that interest rates need to revert lower as an easy policy decision, especially in an election year. I'm not saying they're connected. The Bank of England, of course, does have independence, but there would be, probably some soft power there, let's put it that way, to be able to manipulate interest rates lower to get the GDP up, get people feeling the wealth effect again. That feels good in an election year. So that's one of the more abstract reasonings as to why I would look at cable as being quite bearish through 2024. Could expect to see end of 2024 at 1.17, maybe even 1.15 down at this lower level. So 1.1425 even, but roughly those levels. I wouldn't expect it to break up any time soon, especially if we do again get that risk off sentiment. Dollar gets bid. Dollar is a safe haven. Generally, it's the strongest safe haven. So yeah, that's the way that I would look at cable technically over the long term. This is all long-term stuff. And then finally, if we move over into the commodity space, have a quick look at gold. Gold, in my view, is all about real rates. So real rates are higher now, which means that gold should come off. Gold is purely a real rate trade, okay? You can look at moving averages and things like that, but at the end of the day, what you would probably expect here is for... from a macro-driven perspective, you would expect gold to trade lower and then trade through the 200 weekly moving average. You probably expect something similar to this that's occurring here, just post the great financial crisis, expecting real rates to remain higher for longer, which should cause a really grindy market in gold. So I don't really expect anything too exciting in gold this year, especially with this pattern here, where we've seen it trade much higher, fade all of these highs. It's traded up there, faded all of those highs. It's probably induced plenty of sellers here. They're saying, oh, look, lots of selling came in at this point and then just wants to head lower. So I'd expect it to want to head lower here. 1810 is probably a nice double bottom look out there. So that's where I'd be looking at gold through 2024. Nothing too exciting here, though. I think, as I said, real rate trade. Gold has been bought heavily by central banks, and it'll be interesting to see what the flow of central bank holdings look like for the first 6 months of 2024 as well, because I think it's been a bit too heavy on the buying front. So we'll pay attention to that maybe in 6 months' time and see what the trajectory of gold is then. Today's trading takeout is make sure that you are paying attention to sentiment. And the most objective way that you can do this is if your broker or a large broker offers their position or sentiment index out. So some brokers, they might show that, say, 60% of their book is long gold, for example. If you start to see something like that, you got to think of how a broker tends to make money if they run a B book or if they, are trading against their clients, which is absolutely fine to do. They're going to make money by internalizing that flow, meaning that they don't send the order to the open market and they take on the risk themselves. Now, if someone loses that trade, then they make money from it directly. They make 100% profit, effectively 100% revenue. Whereas if they were to outsource that trade or send or hedge it elsewhere, they only make the spread, and they might hedge or they might internalize part of the flow, which means that they would make revenue on that part of the trade. But really, you want to be trading very, very similar to your broker, because you have to remember most people lose. So if most people are positioned one way heavily in a market, you've got to consider that this is dumb money, this is uninformed money, and this is money that you really, really want to be trading against. Obviously, then key points come into things as to where you can optimize, where to enter, and where to, think that there's an optimal timing of the trade. But generally, you want to be trading at all times against the silly money.